Hi, my name is Nadine Mokoena, a business accountant at Bonmas Consulting, and I'm back for this week's edition of Ask an Accountant. And on this week, we'll be looking at, is your business 100% compliant? So I'll be taking you through some elements of compliance which your business needs to have in order to operate. Okay, today we'll be looking at the first thing, which is income tax. So any company that is registered in South Africa is liable to pay income tax to South African Revenue Services, short for SARS. South African-based businesses will be liable to pay corporate tax on the taxable income that they receive every single year. Companies that are based outside of South Africa but operate in the country or have a branch there will have to pay income tax derived from within South Africa only. So you pay this income tax at the end of your company financial year, so you should file an annual tax return with SARS in order to comply with the laws. Okay, so now we'll be looking at some elements of income tax. The first one is provisional tax. So what provisional tax is, it's not a separate tax from your income tax. It's actually a method of paying your income tax liability in advance to ensure that the taxpayer does not remain with a large tax at the end of your financial year as the SARS Revenue Services. So provisional tax allows the tax liability to spread over the relevant year of assessment. It requires the taxpayers to pay at least two amounts in advance to SARS during the taxable year of assessment, which is based on the estimated taxable income that the company would receive. A third payment is optional at the end of the tax year, but before issuing an assessment by SARS, on assessment, the provisional tax payments will be offset against the liability for normal tax for the applicable year of assessment. So let's look at who a provisional taxpayer is. So any person who receives an income other than a salary is a provisional taxpayer. Most salary earners are therefore non-provisional taxpayers. And then if there are no other sources of income, it is important to note that receiving exempt income also does not make you a provisional taxpayer. So now we'll be looking at a second element of income tax, which is VAT, value added tax. So value added tax is commonly known as VAT, and VAT is an indirect tax on the consumption of goods and services in the economy. Revenue is raised for government by requiring certain businesses to register and charge VAT on the taxable supplies of their goods and services. These businesses become vendors that act as an agent for government in collecting the VAT or the value added tax. So VAT is charged at each stage of production and the distribution process, and it is prohibited to the price charged of the goods and services. Then VAT, the percentage that we charge for VAT in South Africa is 15%, and this was implemented from the 1st of April 2018. So VAT is levied on the supply of goods and services on the importation of goods. The VAT of the importation of goods is collectible by customs. These are limited to the range of goods and services which are subject to the VAT at zero rate or that are exempt to pay VAT. So let's ask ourselves, who should register for VAT? So if you are a business and you're carrying on business, you may register for VAT. You can register for VAT once you've applied for all the different types of tax types. That is your normal income tax. You can also voluntarily register for VAT, but the requirement is that each business must have an excess of 1 million rand and in a year of 12 months. Then it becomes mandatory for your business to register for VAT. But if you want to apply for VAT on a voluntary basis, your company must make, in the space of 12 months, over 50,000 rand for you to apply for voluntarily for a VAT. Okay, now we'll be looking at some employer obligations that your business must have once your business starts employing people to the business. So the first thing is pay as you earn for employees. So this is an individual income tax on the salaries of your employees, and you can register for this with SARS. You get taxed at a progressive rate depending on the employee's salary, but this has to be withheld by the employer. If you have employees, you will need to arrange their pay-as-you-earn contributions and make a regular payments to SARS every single month based on their salary that you will be paying them. So the second thing that you as a company must be looking at once you have employees in your company is that you need to register for UIF, that is the Unemployment Insurance Fund. The UIF is the unemployment insurance benefit payable to those who have been in employment for at least 24 hours per week if they become unemployed, sick, or on maternity leave. It is a short-term contribution based on benefits, and it is funded through the contribution of 2% of the employee's salary. So 1% comes from the employer and 1% comes from the employee's salary, and this will be given to the South African Revenue Services and also the Department of Labor every single month. So this is something that you need to do once your company starts having employees. Another thing that your company can employ, or that a company can apply for once you have employees, is the Skills Development Levy, short for SDL. So SDL is a tax in South Africa payable by employers to promote the learning and development of employees in South Africa. Employers become liable for SDL if their total annual salary bill is more than 500,000 Rand, and then this is charged at a rate of 1% of the total salary bill of the employer. So this is something that you can do as an employer if you want to train your employees, and if you have a salary bill of more than 500,000 Rand, you can apply for SDL through SARS, South African Revenue Service. Then the next thing that you need to apply for once you have employees is COIDA, which is the Compensation Fund Development. This is something that you need to do once you have employees. So any employer, once you register your company and you start employing people, an employer must register with the commissioner within 7 days after on which the first employee has been registered. Anyone who employs one or more part-time or full-time workers must register with the compensation fund and pay annual assessment fees. The compensation fund is a trust fund that is controlled by the Compensation Commission. An employer contributes to the compensation fund. The commissioner is appointed to administer the fund and to approve claims that are lodged by employees or by dependents. This means that the fund will compensate the employees or the dependents and not the employer. The annual assessment fee is of the employer based, so it's based on the employer and the employee's earnings, and the risk associated with the type of work or the profession. Before the 31st of March of each year, all employers, including contractors, must submit a statement of earnings paid to all their workers from the beginning of March up to the end of February every single year. So this is something that a lot of people need, or a lot of companies need to apply for, because this is a compensation that will pay out to your employees if something were to happen to them at the workplace. So that is it for this week's edition of Ask an Accountant. So ensure you use these tools for your business for it to be 100% compliant to operate in South Africa. So we'll see you again next week. So I want you guys to go and like our Facebook page, subscribe to our YouTube channel, and hit the notification bell to ensure that you get notifications on the next time we upload any of our content. Then for all the details of this video, you can visit our blog at bondmas.blogspot.com. Then contact us to help you ensure that your business is 100% compliant on info@bondmasconsulting.co.za. See you again next week.